Ron from Ronald Rohde Law, and in this video, I'm going to talk about the crazy rate hikes that the FOMC just announced. So, unless you've been living under a rock and you've heard about the Fed is constantly increasing the rate. So, yesterday they just had a meeting and they announced a 75 basis point increase. What does that mean for you, and what does that mean for your commercial real estate investments? Ron from Ronald Rohde Law, and in this video I'm going to talk about what is the implication of the rate hikes, what are the natural macroeconomic factors that happen after a rate hike like this, and what you need to be doing in your investing regardless of the interest rate environment. All right, so first let's talk about a little bit just of the mechanics. This is the Federal Open Market Committee, also known as the Fed. That's kind of the federal bank. They're able to set the internal interest rate that they loan out money to other lenders, and they generally view this tool as a hose or a spigot of supply of money, which the money circulating in the economy stimulates buyers, because as the cost of capital goes down, more people can make properties cash flow, they can generate a higher delta, and that's going to be a higher reward or a return on equity for their own equity investment. So when that return goes up, then they're able to stimulate the economy, they're able to put more of their equity at risk, at work in the economy, and basically be willing to take on loans and generate activity. But in this case, however, the economy is overstimulated. We can talk a little bit about the causes, but there's no reason to really delve into that except for the fact that there is rampant inflation, there's incredible demand for everything, and it's partly due to the lower rate of capital. So people borrowing cheaply has stimulated, for example, the residential housing market. It has gone on fire because of the low cost of capital. You've had bidding wars, you have multiple offers, you have all cash offers, no contingencies. And it's really been an unfortunate side effect of all of this money printing. What does this mean for commercial real estate, though? We have seen some of these same effects, right? There's been a lot of demand and a higher price that is being paid by debt buyers. So people who are leveraging up, 70, 75, 80%, maybe even 90% leverage on these properties, 100%, I guess, in some cases, they're able to bid really, really high for these properties, and that's creating the same type of asset or the market inflation relative to the historic values based on historical cap rates, that sort of thing. So what does this mean? I talk to a lot of clients that say, now I'm scared. I'm not going to buy because the interest rates are going up. They're shooting up. Well, I think that's the worst thing that you can do for your investments. If you watch my other video, I talk about how to buy in a rising interest rate environment. Same thing here is, how do you buy when there's some concern that we might be entering or we already are in a recession? It doesn't matter. The key for this video and everything I'm going to say is you need to learn how to buy in all types of environments. So I'll say that again. Learn how to buy in all types of economic situations. It's really important because you need to create your own underwriting, you need to create your own leverage percentage, and you need to know how to stomach your own risk. Because for every situation that other buyers are in, they're feeling the exact same feelings as you. And these same buyers complain about too many buyers also simultaneously bidding on the same multifamily properties that they want. But as soon as the market turns a little bit, pricing is going to come down, debt costs are going up, it becomes more risky to buy these same properties. They're the people complaining that the economy is unstable and their cost of capital has gone up. Well, you can't have your cake and eat it too. If the market conditions are very favorable and easy to lend, there's going to be more competition. You need to be good when you're competing against 8, 10, 15 other buyers. Now that the market has gotten a little bit rocky, we don't know what's in store, but if you have an opportunity to buy an asset that you feel really confident about, you can put your own money into this asset. Put fixed rate debt. We don't know what's coming, but if you can get fixed rate debt for 5 or 7 years, lock that in, because then at least your debt payment is certain. Don't go out on a limb buying on 24-month IO. don't do that. Don't buy on variable rate debt terms right now. So if you can do fixed rate debt, lock it in, buy at a healthy spread where your return is going to exceed inflation, and be thankful that now there's less competition, because I guarantee you, of those 15 other buyers that were bidding on the same multifamily property, half of them are going to disappear. Maybe 3/4 of them are going to disappear. So yes, now you're still competing, but there's less competition. And if other people pass, there are more deals than buyers. So I'll say that again. Because everybody's scared, there are more deals right now than buyers out there. You know, that's really the point of this video is how do we react? And you need to learn how to be comfortable. I think that this should cause everybody to slow down a little bit, take stock in what is their expertise, but have some confidence to be able to make some big moves in commercial real estate, regardless of the economy and regardless of the interest rate. You need to know your product and know your client and know your tenant demand, and you'll be set. So smash that like button. I hope this was useful. Yes, it's a wake-up call, but you can weather this. You can still make money. And indeed, some of the best money in real estate is made during a recession or made during uncertain times. So smash that like button and subscribe if you like the content. We'll see you next time.